So as the market heads higher, what should you be watching? Joining us to talk about that is Barry James. He is president and portfolio manager at James Investment Research. Welcome, Barry. Nice to see you again, as always. What about Mike's?
It's great to be with you.
What about Mike's final point that maybe this market is better prepared to handle the issues that haven't gone away yet, the Fed and interest rates, Brexit, and the trade war?
Yeah, we've had a chance to digest it, I think, and Mike's point about sentiment being off right now, not too bullish, is a good sign that people have already maybe hit the exits that needed to hit the exits, and it gives room for the market to go high. You know, you were talking about getting up those new highs. Shh, don't tell anybody. Let's keep it between ourselves so we can enjoy it.
Yeah, but for that reason, you are pretty cautious on this market from your own portfolio perspective, and you're still very defensive, aren't you?
We're about half stocks and half bonds in our balanced accounts, and the types of stocks we're buying are hopefully ones that can weather the storm on either side. The consumer is buying, and we saw that today with the consumer credit numbers. People are certainly using their credit cards, so that side of the economy, I think, is going to be all right, and that's probably a good place to edge in. But as we've just heard. On the technology side, you get into these these antitrust things. The same thing happened in 2000, 2001, and that wasn't a very good time for the tech stocks. But they've been leading this advance, so there maybe will be a move over into more sane types of securities.
What are you anticipating from the Fed, and how might it affect the market as we edge, daily closer to the next Fed meeting?
Yes, they've given every indication they're going to be cutting probably multiple times yet this year. And as long as they follow that path, which everybody expects, I think the market will be steady as she goes. If they don't do it, that might cause a little bit of fear. And if they do too, very large change, then people will be worried about a recession. But I think they're just kind of steady as she goes, bring down those short-term rates because they're really kind of out of whack with the rest of the bond market.
They are, but we've been hearing from banks today and lately that those rates are cutting into their net interest margins. It's hurting their loan portfolio. I mean, all these other areas that we talk about those parts of the economy that benefit from lower rates, but there are still plenty of parts of the economy that don't, right?
Yeah, the banks make it on the spread between short-term and longer-term lending that they do, and that's pretty narrow right now. So they're looking for fees in other areas, and that's you and me.
Right.
that they're trying to get those fees from where they can't get it on the spread, as it were. So they're kind of trying to come up with different products and different services that they can charge us for. I'm not too worried about the big banks. I'll be honest.
All right.
I'm really not.
What would you recommend in terms of being somewhat defensive? Give me a couple of sectors that you like.
Sure. I would go with the consumers, especially non-cyclical types of stocks. That would be, like the Krogers of the world, or even on the consumer side, the Walmarts. They're going to continue to have very, very good business. I would say some things that are sure to keep showing up at your doorstep are the waste collectors like Republic. We like them pretty well. And if I also look at the real estate area, some pockets in the real estate area like public storage and things like that look pretty good.
Barry James with James Investment Research. Thanks.